Hey guys, welcome back to another week of Mortgage Matters in Minutes. I'm Brent Rasmussen, owner of Mortgage Specialists. Just as my title might say, I have 5 different certifications and love to educate and inform. And today's topic, what is mortgage insurance and how does it work, is a conversation that we have nearly every single day. And before we get into this, I just wanted to mention today is Valentine's Day. Happy Valentine's Day to all out there. But today, mortgage insurance is a topic that gets very widely discussed, mainly among IC buyers that are buying as a first-time home buyer or others that are putting less than 20% down. And parents and grandparents remember mortgage insurance 10, 20, 30 years ago, that it can be very expensive. And people are trying to find ways, obviously, to make their payment the most affordable they can. And if they don't have to pay mortgage insurance, that's one less part of your payment that has to be made. So first, let's talk about what mortgage insurance is. Just like any word insurance, it insures for a risk. And what is the risk that it insures? It insures for the lender. It protects the lender in case of a borrower going into foreclosure. And if they do go into foreclosure, there's certain insurances that the lender receives for the risk that they are taking out, giving that loan to that particular borrower. A lot of people say, well, what about the interest that I'm paying? And what about this that I'm paying to the lender and the closing costs? Shouldn't they make a lot of that? And it's understanding the whole system and how it works, the whole secondary market. It's much more challenging to understand that just because you pay an interest amount doesn't mean that covers all of the lender's interests. So mortgage insurance obviously protects the lender that you're writing your check to for your mortgage in case you don't make your payments. There's many different words that get thrown out there. There's private mortgage insurance, there's mortgage insurance premium, and VA has a little different word. Even though it's not a mortgage insurance, it's called a funding fee. So let's talk a little bit about what those different mortgage insurances are. So first of all, the most common mortgage insurance that's out there is called private mortgage insurance. Why is it called private? It's called private because the lender doesn't issue its own mortgage insurance. It has different private companies or corporations across the country that issue mortgage insurance. Some of these are Essent, Radian, MGIC, and that's their sole purpose, is to give mortgage insurance away on conventional loans through Fannie Mae and Freddie Mac. And us as lenders can choose to look around and use different mortgage insurance companies, and whoever has the cheapest usually is the best for our borrowers. But as competition strikes and ensues, most mortgage insurance lenders that are private keep their pricing very similar. Unless they get hit by a large volume of foreclosures due to a certain situation, generally mortgage insurance between private company and private company is very similar, if not exactly the same. So while we do search around here at Mortgage Specialists for different mortgage insurance companies to find out which one is the cheapest for you, generally speaking, we find that it is very much identical among company to company. So we spoke about what's private mortgage insurance. The next word, we basically just take the same letters and we move them around, and we call it mortgage insurance premium. So basically, MIP is nearly the same as PMI, except for mortgage insurance premium is given away on FHA loans. And FHA is a government loan. So being that it's a government loan, the government is insuring that particular mortgage insurance. And so mortgage insurance premium is just a different word, only solidified for FHA loans. And the last we talked about is what's called a funding fee. And while VA doesn't have mortgage insurance as an exact word, they use what's called a funding fee, which is very much exactly the same. It does the same thing. It covers the veteran's affair in case a borrower goes into foreclosure. That funds are used to help the cost of hiring an attorney, filing all the legal paperwork, getting a realtor to list the house for sale, cleaning up the property, possibly doing all the things that we need to do as lenders to transfer the property from one person to the other person. So the biggest reason why this is a discussion is how costly is mortgage insurance, and that's why it's such a big discussion. And not everyone knows what the cost is. So for conventional loans, the cost of mortgage insurance currently is one of the cheapest it's ever been of all times. And why is it cheap? It's cheap because in relationship to time or over the history, because we've seen the lowest amount of foreclosures happening currently than we've had over the last 30, 40, 50 years at any point in time. So as we look back at insurance, insurance covers risk. So if there's low risk, the premiums should come down, just like car insurance. We've seen for some individuals, car insurance came down during the pandemic because people weren't driving. So as we see this happening, as less foreclosures are occurring, conventional mortgage insurance lowers and goes down. So many times when we give people quotes, they realize it's not nearly as expensive as putting maybe 20% down to get away from paying mortgage insurance. Conventional private mortgage insurance all comes down to different tiers. It depends on what your credit score is and how much you're putting down and your debt to income ratio. So all three of those things price into what your mortgage insurance is. So the higher your credit, the more you put down, and the lower your debt to income ratio is, the cheaper the mortgage insurance is. If you have low credit scores, a lesser down payment, and a high DTI, obviously you're higher risk. So they're going to charge you more for that mortgage insurance, just like you would get car insurance, house insurance, and health insurance. The more risky you are, the more they're going to charge for you. Where if we look at FHA mortgage insurance premium, there's two different kinds of insurances. There's upfront, where they charge you a flat percentage on top of the loan, and they'll also charge you a monthly amount that you pay every single month. For FHA, it is more standardized. It doesn't care necessarily what your credit score is, but it does care about how much you put down and what type of term you take. But generally speaking, for FHA mortgage insurance, everyone gets the same priced mortgage insurance. And if we look at mortgage insurance as an overall whole in comparison to conventional mortgage insurance, FHA MIP is more expensive for an average borrower than conventional. Why is that? Because FHA mortgage insurance goes for the entire life of the loan. So if you take out a 30-year mortgage, the mortgage insurance you pay on FHA goes for a full 30 years. So that can be much more expensive. Also, the amount you pay monthly and upfront, generally, if we look at good credit score people or great credit score people, the mortgage insurance on FHA is generally more expensive. So usually when we're looking at getting pre-approved, mortgage insurance is a huge factor besides the interest rate to figure out what loan program gets you the best bang for your buck or the best payment. Where if you have a great credit score, you might not want to go with FHA because the mortgage insurance premium is much more expensive than on conventional where you can get private mortgage insurance. So if we look at private mortgage insurance on conventional loans, people ask, when does this fall off? If I put down 20%, I don't need to take out mortgage insurance. And you are correct. Also on conventional loans, once your loan balance gets to 78% of the original value, your mortgage insurance automatically falls off. So to give you an example, many people put down about 5% down. If we look at just time, it takes about 10 years or so for the mortgage insurance to completely fall off if you're just making the minimum payments. If you make extra payments and you get to that 78% of the original value, your loan balance gets to 78% of the original value quicker, the mortgage insurance automatically falls off. But you can also request with certain private mortgage insurance companies, if you've been on time with your mortgage payments over the last 12 months, and you've had your mortgage insurance for a certain period of time, it depends on the mortgage insurance company, you can ask your lender to pay for an appraisal or to order an appraisal for you that you might need to pay for to have the mortgage insurance removed. And so a lot of times what we look at is the cost. If you're only paying $40 a month for mortgage insurance and the cost for the appraisal is $600, we do the quick math and we divide those by each other to figure out what the break-even time is. Does it make more sense just to keep paying the mortgage insurance to get it to fall off versus paying an extra expense of $600 for the appraisal to remove the mortgage insurance? Again, mortgage insurance can be very, very complicated. It can be different on FHA loans if you're doing a streamlined refinance or if you're doing a different type of loan that exists out there for a conventional first-time home buyer. Not all of them turn out to be exactly the same way, so it's best to when getting your application filled out and completed, talk to the lender and ask about your mortgage insurance options, because it's not as easy and as simple as you may see it to be. A lot of people know when shopping for a mortgage, they want the cheapest payment and the cheapest interest rate, but they forget about mortgage insurance, which can be significantly a large portion of your payment, depending on if you have great credit or not so perfect credit, and what type of loan program you're looking at. So the next time you're getting pre-approved or talking about a mortgage loan needs, ask about mortgage insurance. Hopefully today we educated you on the basics of mortgage insurance, that it can be a little bit different, but obviously it depends on the loan product. Private mortgage insurance over mortgage insurance premium with FHA can generally be a little bit cheaper if you have great credit. Again, here at Mortgage Specialists, we love to educate. We love to answer questions. We're always here in the Omaha, Nebraska, Iowa area to educate and answer any questions you may have personally about any needs that you have. You can reach us at the phone at 402-991-5153. Also, you can jump on our website at mtg-specialist.com, or on YouTube here. We have our weekly Mortgage Matters in Minutes every Tuesday afternoon, just to give you some general education, 7 to 8 minutes of information so that you can be the best educated you can to get the best mortgage for your needs. I'm Brent Rasmussen, and we'll see you here all next week. Thank you. Mortgage Specialists. Driven, trusted, reliable.